and today we have Jeremy Harbour with us, and we're going to dive into the world of direct listings. So I think, Jeremy, I mean, the obvious place to start it really is what is a direct listing, and often we hear from business owners some confusion about IPOs and direct listings, and they're not quite sure about the two. So maybe you can enlighten us.
Yeah, so I think, look, the first place to start, I think, is yeah, a direct listing is a way of going public. An IPO is another way of going public. The primary ways that somebody would take their company public on a stock exchange are an IPO, which is where you make an offering of your shares to the market for the first time and list at the same time as that offering. A direct listing is where you skip the money raising part and just go straight to the market. Now, from a complexity perspective, 90% of the work is the public offering. It's the capital raising. That's where the prospectus is, the road shows, the costs and the timing all gets carried away is in that part of it. So direct listings are a much quicker, much more efficient way to go to market. It was kind of made famous recently by Spotify, who decided to do a direct listing, whereas nearly every other major listing has traditionally done IPOs, and the investment banks make a fortune out of doing IPOs. So they like you to do an IPO, so it's quite controversial for them to do a direct listing. You can also go public by reverse merger or by reverse takeover, RTO or reverse merger. A reverse takeover is where you merge with an existing public company, but the amount of shares you receive as part of the merger makes you the new majority. So you effectively take over the company by merging. And a reverse merger is where you don't take a majority as part of the transaction and you just join the share register and join the public company. And so we do all four of those. But direct listings have become really, really popular amongst Harbour Club members and partners that we work with because of their kind of speed and efficiency. So we've kind of nailed down a process that allows companies to go public in kind of 90 to 120 days, as opposed to the kind of 18 months to 2 years that it's taking now to do an IPO. And according to a recent report by Merrill Lynch, the average cost of a listing now is $2 million US to go public. We can effectively do a direct listing where it doesn't cost the business owner a thing. So effectively a fully no money down, go public transaction. Now, this gets really interesting with the kind of people that you're partnered up with who are building groups where they have an equity stake in the group, because obviously if we take it public, that equity stake now has some value. They have an ability to effectively, go and place some of those shares or sell some of those shares in the future. Or by having a public company, attract more companies to come and join the group. Now, this is a really important factor because most people think you go public to raise money or to exit. And actually, it's not a great way to raise money. It's you can raise money as a private company with the same amount of work, because raising money always involves quite a bit of work. So there's no need to go public to raise money. And the other thing is the exit factor. Well, when you sell a company or when you sell shares in a public company, you're selling them to investors who believe in the future of that public company. And the last thing an investor wants to see is the founders of the company selling their shares, because why should they as an investor believe in the future of the business when the people in the business don't believe in the future of the business and are selling their shares? And so people kind of have it all back to front, that they think this is, I'm going to go public and I'm going to offload all of my shares. Well, if you pick up the Forbes list, the richest people in the world, every single person in the Forbes list, bar none, look at all of the top richest people in the world, they took their companies public and did not sell all their shares. So Jeff Bezos, Elon Musk, Mark Zuckerberg, all of them. Warren Buffett. In fact, if you keep scrolling down long enough, you'll find the real estate guy, which is the first one, which is not made their money from taking their company public and using it as a platform to grow their business. And so the key here is using public markets not as an exit vehicle, not as a capital raising vehicle, but as a vehicle to grow, a platform to grow your business. It gives you enormous credibility. So we take some companies public purely for the credibility. So we have a rail technology company at the moment. We've taken them public because they're competing. They've got a $6 billion pipeline of business that they're executing on at the moment. But it's a tiny company right now, and they're competing with six massive multi-billion-dollar competitors. So they're up against people like Siemens and Alstom, these massive multinational companies, and they win all their business. All their business is basically government contracts or quasi-government contracts, and it's all won by tender. And if you're a public company with a properly set up board of directors and a properly issued prospectus, you know, that has all of these boxes ticked, like your modern slavery policy and your, you know, ESG policy and all of these things, it makes the first 30 pages of any tender document really, really easy. You qualify on all levels, and it gives you that credibility to go and win those pieces of business. The other thing is it makes M&A really easy. We're all big fans of building groups here. We realize that there's huge amounts of shareholder value that can be created by building groups, and building groups is way more easy when you've got the credibility of being a public company and the ability to issue stock as part of the transaction or issue bonds as part of the transaction, and just be more creative with the deal structures that you're using to get those companies to come and join you. So I think if you use it in the right way, it can be hugely effective. And the number of people I meet who go, hey, that's a really great idea. I'm going to do it next year, or I'm going to do it when we're bigger, or I'm going to do it when we have more profit. And actually, you would be bigger, you would get more profit, and you would help yourself along by doing it first. Everybody tells me they want to build a group and go public, whereas in fact, they should go public and build a group. It's much easier to build a group when you're public, and actually it's much harder to take a group public than it is to take a single company public. There's a lot more compliance, admin, just general legal bullshit that you have to navigate when there's 5 or 6 companies than if there's one. So you want to take one public to give you a cornerstone, to give you a foot in the door, and then use that as the leverage to go and acquire all the others. And let me tell you, if you took a small cybersecurity business from Surrey and took it public, you'd be super interesting to all the other cybersecurity companies all of a sudden, because they'd be thinking, what the fuck are these guys up to? Why have they gone public? What do they know that we don't? And all the doors would then be open for conversations with all the other people in that sector. But, sorry, that's a really long answer to a short question.
No, I mean, it's a great answer, but it also opens a number of questions. One of them is, what is the key benefits from, say I'm a business owner, I'm thinking about direct listing, or I'm debating whether to do exactly what you said, wait. What are the key benefits and what's the criteria, what size company and everything else?
Yeah, so I mean, look, we can take something public. I mean, if we can see a pipeline of acquisitions or a really good equity story, we can take something quite small public. So, for example, we took a company that has a groundbreaking 3D TV technology public, even though it has very, very low revenues and profits. The rail technology business is very small. It did like 4 million in revenue last year and maybe 500,000 of profit, but has this insane order book. And a proven, IP protected technology that's winning lots of tenders. So the future revenues for that are really exciting. So those kind of businesses have a really good equity story, but very small revenues. And then we have businesses that, we just took a company that's doing about 6 million of revenue and 1.5 million of profit public. So again, quite small business. But they've got a huge pipeline of acquisitions, so they have the potential to grow that business massively by doing acquisitions. So it's a less exciting sector, but a good opportunity to grow. And I think as long as you're doing more than about 500,000 of EBIT, because bear in mind there are going to be costs associated with being a public company once you're listed. But as long as you're doing more than 500,000 of EBIT, and there's a good story, either an equity story around the business itself or an acquisition story around consolidating an industry, then we could look at it as a go public situation. And we'll evaluate it, and if we like it and we can see how it can be scaled, we'll put our money where our mouth is, and there's no cost to the entrepreneur of taking it public.
So on the other side, from the deal makers, so obviously a business owner can become a deal maker when they're scaling a group. So what's the benefits of them being a public company as far as the acquisitions are concerned?
Yeah, so one is the credibility. It's so much easier to go and speak to other business owners about joining a group when you're public. you've got a great, you've achieved something that they, probably had on their bucket list that they never thought was possible. You have currency. You can issue stock or bonds as part of the acquisition consideration, which you can't really do as a private company in quite the same way. You can raise money for acquisitions by selling shares, where the shareholders that you bring on are just ordinary shareholders. If you go and raise money as a private company to do an acquisition, you'll often find there's lots of strings attached with that money, or they want complex shareholder agreements that that tie up in knots. Whereas in a public company, all shareholders are equal, and so they can invest in the shares, but they don't get any special rights or differences between their shares and anybody else's. So you don't end up with the tail wagging the dog when it comes from an investor perspective.
Okay.
Is there an optimal time in the journey of a business that will eventually be a sort of candidate for a direct listing to pull the trigger? Is there a time at which maybe the business owners left it too late? You mentioned it's better to go down the direct listing route and then build a group rather than the other way around. But is there, other than that, a sort of optimal time to go for this?
Not really. I mean, look, if the business is distressed or has problems, it's not going to work. But they don't have to be fast growth if there's an acquisition story. I think we can look at a lot of different types of cases. So I mean, we're looking at what I would classify as quite boring businesses, and then we're also looking at businesses that are very exciting and do very different things. And then of course, I think the biggest criteria is that the business doesn't need to constantly raise money in order to survive. So if it's constantly having to raise money just to keep the lights on, that's also not going to be sustainable as a public company. It has to have matured to a point where it can operate with its own cash generation.
So, Jeremy, if you were advising a profitable 3 million turnover revenue business today, what would the next 12 to 24 month runway look like?
Well, yeah, I mean, the listing process that we've nailed down now is getting pretty efficient. So we would potentially have them listed in the first 4 months of the relationship, and that's including quite a lot of stuff that has to happen around. That's a busy 4 months for us. Once they're listed, then it really comes down to the management of the company executing their strategy. Now, if part of that strategy is acquisition, and you guys are helping with the acquisitions, we can help with the DD and onboarding of those transactions and support the public company side of the requirements, which is all the legal announcements and stuff that have to be done in relation to that. It's really we're there to support. We're not there to kind of tell them what to do or to control anything. But if we can get behind their vision and help them achieve it, we will do.
So next question I've got here is, you've helped multiple businesses to list directly. What's the single biggest mistake you see owners make before they even start the process?
So the first one, I think, is they believe there's a bunch of things they need to do first, and that just creates unnecessary kind of procrastination. The other thing is that they try and treat it like an exit, or try and take too much money off the table. And then the other one is trying to create too much liquidity in the stock. So this is, everybody believes that you have to have this highly liquid public company, and that's just not the case. What you really want is a very stable public company that doesn't have a lot of volatility in the share price, that you can grow on the public markets and move to a more highly liquid exchange at a later date. So, for example, if you take the 3D TV company I was mentioning earlier, we've actually taken that public on Vienna, which doesn't have huge amounts of liquidity. We will grow that business in Vienna until it's big enough to move to a main market, and we will then move it to Frankfurt. And we will continue to grow it there until it's big enough to move to NASDAQ. It is a California-based technology company. It belongs on NASDAQ. But nobody should be on NASDAQ with all the cost and all the compliance that goes with that until they're somewhere between 1 billion and 2 billion of market cap. So the idea is you get to that 2 billion market cap before you move to NASDAQ, and that way, yeah, you maximize value for shareholders and for the company itself in terms of how it can punch above its weight and achieve more things.
On that note, where are they currently at the moment? What would you currently value them as a SME?
Yeah, it depends on the type of business. I mean, that 3D TV company, they'd invested 150 million in developing the technology over the last 12 years. Those investors had come in at a much, much higher share price, one that we couldn't get our heads around. And they did have a really nice order book from trade buyers that had given purchase orders valued at about 160 million for purchasing this product, but nothing had been delivered at this point. So this was a very much sort of cutting edge business. We ended up acquiring it for 53 million in a reverse merger into an existing public company that we'd created. So it wasn't a direct listing; it was a reverse takeover, effectively. Yeah, I think for shareholders it was great value because there's 150 million of sunk cost in their IP, but huge order book going forwards and a very exciting business. So but that's an unusual one because it's so tech led. Typically, yeah, we have to look on a case by case basis, but typically it will be a valuation that far exceeds an exit valuation, but also remember they can't exit. So it's not really a comparison. And so people always tend to try and compare it. So they go, oh, we think we're worth 10 million and, if we go public, we can get 14 or something. But it's like comparing a car with a tangerine. They're completely different topics. So it's it's not something they should be comparing.
So just that we've got a meat processing deal in Portugal on the go, 47 million turnover, one that we spoke about a number of times. How would you approach that deal in this context about going listing first and then growing the group around it? Because obviously we've come across a number of different stumbling blocks due to local laws and things like that. But I'm just wondering how you would have approached it.
Yeah, funnily enough, we've just done a deal in Spain that we've listed. So Portugal's right next door. But the way we did it actually is we created a UK PLC as the holding company, put the Spanish company underneath it and took it public from there because all the corporate governance and everything was so much easier to do through the UK. And because of the double tax treaty, there's no tax implications of doing it that way round. So we just did it like that for ease and speed. But look, with any deal, it starts with an initial company that you can inject in. And so with that one, you need to complete the transaction to own it. Once you've completed the transaction to own it, we can take it public, and then we can go out and find loads more that look like it or other things that we could bolt in. Now, I know with some of your kind of group members, they've got stakes in companies. So 15, 20, 30% stakes in businesses. They can still take those public. Obviously, they need the other party, the other 70%, to be on board with the transaction and to buy into the vision and the dream. But effectively, we can take them public as a first, an anchor, if you like, or a cornerstone that we can then go and add other businesses into. So you either need to own it or own a stake in it and have the ear of the balance of the shares, and then we can go ahead and use that as the starting point of a roll-up. All you need is an asset, and you're ready to go.
So, question from Juan: on average, what are the operating costs for compliance once you are listed?
Yeah, so this is one of the main good question as well. This is one of the reasons why we do our pathway. So we start on a junior market, then we go to a main market, and then we go to a highly liquid market. So it's a 3-step process. And that initial step, the first step, is an unregulated segment or junior segment of a market. You can actually get away with about 30 or 40 grand a year of incremental cost to be there. The actual exchange fees themselves are 2 or 3 grand. It's not much, but then you'll have to be audited. You have to do an annual report. There's a few extra things. So, when we say 30 to 40 grand, it's a fairly good sort of estimate. So yeah, not that expensive at all. But it's a good idea if you do have enough profitability to be able to support that. And obviously, as you move up through the markets, then the cost and complexity gets greater and greater. So as the business develops, you then move up the food chain, and the costs go up commensurately. I mean, one of the examples I always use is that legal fees for a filing. So you want to file something with the exchange. In Europe, you'll pay about 2 grand for a filing. In London, it will be about 20 grand. In New York, it'll be about 100 grand. And it's the same activity. So it's just the lawyers in New York have really figured out how to charge for shit. The UK is catching up, and the Europeans haven't figured it out yet.
From an owner's point of view, what are some of the things, Jeremy, that change on day one of a direct listing? Because a lot of the business owners that we speak to, one of their fears is that they're going to lose control of the business. So what are some of the things they have to get their head around that will be different from having a private company as opposed to a public company?
We do a training kind of onboarding session with them. And 90% of it is kind of social media and what they can say in public. That's really the main thing that changes. All the rest of it is just a little bit of business growing up. Your financial reports and your financial numbers have to be right. Whereas in a private company, they don't have to be right. You can figure it out later. But if you report half-yearly numbers, and then at the end of the year, you realise something massive was missing, or there was some glaring error, you could be kind of accused of misleading shareholders. So your finances need to be accurate. Your financial reporting needs to be accurate, and your social media needs to be clean, and not being seen to promote your stock or do things that or annoy certain aspects of the government bodies. So, but that's basically it. Nothing else changes, and there's zero change in control. I mean, a business is controlled by its directors, and its directors are elected by its shareholders, and the business founder is the majority shareholder and the directors. So no one can replace them. They're the only people that can run it. They're the only people that can tell them what to do. From that perspective, they are 100% safe. Now, we might recommend that they put some non-execs on their board to support their, the quality of their non-executive function. So in other words, independent advice and that sort of thing. Entirely up to them if they take that or not. So we can make suggestions, but it's entirely up to them whether or not they take those suggestions. And those directors, whilst of course they have a vote, will never have a controlling vote, and the shareholders can always kick them out. So there's zero risk of any loss of control. The corporate governance is very, very similar to a private company in terms of general meetings, election of directors, all of that kind of stuff is basically the same. So yeah, there's no risk there.
No. So we've talked about listing in Vienna. So are there any other exchanges around Europe or anywhere else that are trying to position?
We've actually only ever listed in Vienna once. So there's loads of these junior markets. Pretty much every city you can think of has a junior market. So we've used Sweden, Paris, Vienna, Frankfurt, Dusseldorf, Stuttgart, Berlin. There's loads of them.
Yeah. So on here, an anonymous question. If you are a 60-year-old founder of a highly profitable manufacturing business, and you are starting to consider what the end game looks like, you are merging with the competition and selling to trade or PE. Why would you choose a public listing instead? And how would you be able to have the cash event?
Yeah, so don't go public. If you're minded to sell your company, sell your company. As you say, PE or trade sale. Going public is at least a 5-year plan, and maybe longer, but it will create insane wealth. So if you have an ambition to work until you're 70 and to build something huge, then a direct listing could be a solution. But if you're thinking about selling and thinking of this as an alternative to selling, it's an awful alternative because it's going to be extremely fun, extremely exciting. Everybody will be looking at you in your industry, but it's not a horse you can get off very easily. So you need to be ready to finish the race.
On that note, having a front man for the business before you direct list, having that right person leading the ship and them being the shareholders, i.e. the owners, could you position it that way for argument's sake, if you get where I'm going with that?
Yeah, I mean, look, so, in a business like that, somebody could come on board as, say, 15, 20, 30% shareholder and be the person out front. So they would take up a lot of that slack. But if they're exit minded, they're just going to be looking for the first opportunity to offload their shares, and that's not great for investors, and that's not great for the story. And so, I would always say, plenty more fish in the sea. Go find one that really wants to do it.
Yeah, I was meaning more like you put in a CEO to run the company, and then the owners step back as purely as shareholders. Then you do the direct listing, and that.
The biggest companies in Europe pretty much operate like that. The Estee Lauders, L'Oreal's, all of those. They put professional management in. They become a public company. All the public company shares are parked with the family office, so the family can't sell them. And then the family office manages the income that's generated from the shareholding and divests into other things. So all those family offices that you see for all the big companies that were formed, that's normally the method that they followed. They've taken it public, put professional management in, and put all the shares into their family office.
Perfect. Okay.
And in terms of valuing a company that you're taking public, how does that? We've got a question here. How does that differ if you were just buying a company through the normal channels rather than how would you value it if it was a direct listing? What's the mechanism?
So private companies tend to be valued on historic performance, and public companies tend to be valued on future performance. So what you tend to find is that obviously next year is always going to be the best year ever. So future performance tends to outshine historic performance. And so public companies do attract a significant premium over private companies. I think, if it's a small, boring business, you might be 30 to 40% higher on a go public valuation than a private valuation. If it's something exciting, then it can be orders of magnitude higher.
Yeah. Okay. And is there a route for shareholders to get a partial capital event at the point of listing?
Not really. Now, there are some mechanisms for taking some cash out over a shortish period of time. So we have a number of mechanisms over the first 18 months post-listing to take some money off the table. And there's normally a little mechanism at the beginning, for small amounts. If somebody wants a few $100,000 or maybe even to get a few $100,000 into the business to, pay something off or do something that needs to be done ahead of listing. But if you're talking significant chunks of money, then it doesn't work. You need to, if they're exit minded, this isn't the right route for them. But yeah, we can do bits of funds off the table, but not lots.
Okay, going back to something we were talking about earlier, what's some of the biggest myths that you hear from founders about listing their business, especially around the cost, the complexity, and the control?
I think, look, that is the myths that people come up with. So I think the first one is they're just obsessed with selling the company, and I tell them this is not a good way to exit, and they go, okay, great. So I need to sell like $3 million worth of shares. So all roads lead back to Damascus, kind of thing. So basically, if they can get that out of their head and maybe just, like I say, taking a bit of money off the table or a bit of money into the business, something like that, but leaving the rest in for the really big growth opportunity, then that's a conversation we can have. And then I think just people don't realize that perhaps they could do it now. That they're just under the impression that it's not possibly something that could ever work for them. And like I say, with the right story or the right acquisition opportunities in their sector, they absolutely can do it.
Fantastic. Any other questions for Jeremy?
Yeah.
No, I've got nothing else coming through. I think we've covered all the other questions just going through.
We've got a couple there, and we've got 4 outstanding at the moment. So somebody's asked, can you give an example of a private versus direct listing valuation? Could you, I know you went through it high level, but could you actually give a comparison of what that could look like?
Yeah, I mean, like I say, in a boring business, it's maybe, like a engineering company or something like that. It's probably going to be like a 30-40% difference. So, whereas if an engineering company is doing $1 million a year of profit, it might get, 5 to 6 million of private valuation. It might get 10 as a public company. That sort of level of difference.
Okay. Somebody asked, liquidity is often the hidden prize. How can a direct listing create liquidity without forcing the founder to exit or lose control?
So again, liquidity is coming back to the ability to sell the shares. So if they need to sell the shares, they should just sell the company. But if you grow the business either through acquisition or organically on the junior market, and then you go to the main market, on the main market, the liquidity increases quite dramatically. And then obviously, when you get between $1 billion and $2 billion of market cap, you go to NASDAQ, where you have lots of liquidity at that size. And, at both those stages, at the main market stage or at the sort of NASDAQ or New York Stock Exchange stage, you can hire a large investment bank to represent you. And at that point, you can always sell a block of shares or get some liquidity from your shares. But that's typically 2 to 3 years down the line, maybe 5 years down the line in the process. But you're also then looking at an order of magnitude. You might have listed that engineering company at 10 million. You're probably 300 or 400 million at this point in valuation. So you've huge multiples in terms of your net worth at that point.
Good. Any more for any more?
Yeah, there's a couple more in there. So if you have 2 companies that in total make up more than 500k in EBIT, can you take it to direct listing and then have the second one join, I gather?
Yeah, I mean, look, it depends on the sector. It depends if we can create an exciting enough story. Like I say, you want that cornerstone, you want that initial listing so that you can go out and target other businesses to get to a bigger scale. So yes, you could. It would be at the bottom end of the valuation, kind of, or the bottom end of the scale that you could do something at, but you could do something.
Okay, it says INEOS regularly issue bonds as private company using Luxembourg. Oh, no,
INEOS, yeah.
Yeah. Do you know that question, Steve? Because I don't get it either.
So INEOS regularly issue bonds as a private company using Luxembourg. This is from a Manchester United fan. I know this is. Using Luxembourg. Is that a strategy to use?
I mean, look, anyone can issue a bond through Luxembourg. INEOS has the advantage of being a massive company that's extremely well known, so people trust their bonds. Typically, if a private company issues a bond, they're not very marketable. They're not very easy to use. But public companies issuing bonds do give an extra level of credibility and accountability. So yeah, I've seen using public companies to issue bonds is quite a good way of doing acquisitions.
Yeah.
Ronnie's asking, if it's not an exit plan or a capital raise strategy, how does this create the insane wealth for owners that the mechanism that generates the wealth? I probably missed the point.
Yeah.
Also.
Yeah, I mean, it's basically about not spanking all the shares into the market tomorrow. It's about using it as a platform to grow so that there's real liquidity and real value that you can take off the table. So as I say, when you go to the main market, so at 400-500 million market cap, you could place 20% of that, which is 100 million, relatively easily and take that off the table. Now, the really wealthy in the world don't do that. So the Jeff Bezoses, etc. Jeff Bezos doesn't sell Amazon shares. he deposits his Amazon shares with JP Morgan and he borrows money against his Amazon shares. So, he famously borrowed $500 million and bought a yacht and didn't pay a penny in tax because it was a loan.
Yeah, I saw something about Elon Musk did something like that. Rather than getting paid, he asked for options, share options when he first did it, and it's millions of shares, and then he does exactly the same, deposits them to go get loans, Lombard loans, rather than gets paid.
Yeah, in fact, Elon Musk is one of the few in that list of names I gave that does actually sell shares, though. So I think in 2024 or 2023, he paid $11 billion in tax. He was the highest taxpayer in the whole of the US. And that $11 billion was because he was selling Tesla shares and paying the capital gains tax on them.
Wow. Okay. So if you list on a European junior market, can your main operating market be on the South America? Hang on. Do you know what that means?
Yeah, if you list in a European junior market, can your main operating business be in South America, or do you have to operate in Europe?
Yes.
No requirement to operate in Europe. So we've got a company from California that's listed in Europe. We've got a company in Spain that's listed, well, obviously in Europe, but we've got companies in the UK. You can theoretically list a company from anywhere, subject to, robust audits and all the rest of it.
Mm-hmm.
So some jurisdictions obviously aren't trusted or are sanctioned. So you might struggle to list a Venezuelan company.
Yeah, if this isn't an exit, this is from a deal maker's perspective, or by a business owner buying another business. If it's not an exit route, what is the best way to position yourself for the equity in the listed company?
Yeah, so just having a stake in the company in the company that's going public. So if you've got 15-20% stake in the private company when it goes public, you obviously end up with a big chunk of the public company once it's listed. And as I say, for taking a few $100,000 off the table, there are mechanisms we can use to help you take a small amount off the table. Which for a deal maker, if you can take 200,000 or 300,000 out and leave a few million in to grow, and you can do that a few times a year, it's not a bad gig.
Yeah, but we've spoken about the wealth building from the people that, the shareholders staying in, the owners. What are some of the things that they can do? I mean, obviously you've got bond shares, you've got things like Lombard loans and that. Is that a mechanism? Could you talk a bit more about that and the mechanism that they can leverage to build their own personal wealth?
Yeah. So, of course they can use Lombard loans and lending, but typically only once you get onto the main market and you've got, significant trading in the shares. So in this early stage where you're on the junior market, there's not a lot of options other than like a gradual sale, which, like I say, we can organize, small gradual sales. Where it goes wrong is where people want to take 3 million, 6 million, something like this off on the day of listing. That doesn't work, but a few $100,000 as they go through the process is quite doable. But they achieve that by selling their shares, so then they have less shares for later on.
Okay, if you go public and the share price tanks, do I still own the company as the owner?
Yeah, so if you own the shares, you own the company. But the only way the share price can tank is if other people have the shares and they've sold them, because the share price is a factor of supply and demand. So if somebody's selling shares at lower and lower prices and people are buying the shares at lower and lower prices, then the price will go down. If the shares are not available in the market to buy or to sell, because you own them all, then the price remains stable. And this is what I was saying about not creating lots of liquidity as part of the go public transaction, but generating focusing on growing and moving up exchanges so that shares only then get sold in the market when there's proper liquidity there to support it.
Yeah, governance often scares a lot of entrepreneurs. So in plain English, how does that actually change when you become a directly listed company or listed company, sorry?
Yeah, like I said, there's only two areas really that feel different, and that's financial reporting and what you can say in public. And obviously when you go up to a main market, it's a lot more strict and a lot more robust. But in the beginning, on the junior market, there's very little change. You're really a private company that has its shares for sale on a public market. So there's not much difference.
Okay. I think there's a couple of other questions in there, Steve. There's two left.
Can you effectively acquire a company by positioning it as going public and then using the new listed valuation as leverage to sell bonds to raise the capital to pay for the business at the agreed price to take ownership?
I mean, theoretically, all of that makes sense. The selling the bonds part, in my experience, is quite hard. But we use the bonds as currency to acquire companies because selling them is tricky.
Yeah.
But it's a willing buyer, willing seller thing. So if you've got somebody that's really good at selling stuff and can find the buyers for you, then that has potential. But yeah, I mean, in my experience, it's relatively easy to get a stake in a company, for solving some problem or adding some value. And then the next thing you could do is then take that public. And the next thing you could then do is help them find other businesses that could come and join, which you could also have stakes in at the point that they join, and create a very large public company that, you have a decent stake in.
And if you've listed, but the promised long-term growth doesn't materialize, but you still have strong EBITDA, would you be able to reverse out of the or delist, I guess is the question, isn't it?
Yeah, you can delist. I mean, or for example, you can put it up for sale and a buyer can take you out, take you private effectively and acquire you at the same time, like a trade sale, for example. The listing has value, so you would have the company that you could sell, but you could also use the listing to put another company in or do something with.
Yeah, so you must come across business owners that have had advisors come in and give them different advice about IPOs and listings. What's the most common ones that you go, oh, that's completely wrong, or you've got a different way of looking at it?
Yeah, so the advisors are all affiliated to exchanges. So if you go to London, they're going to recommend AIM. If you go to Paris, they're going to recommend the Euronext, and they don't really have anything else to sell. So it's asking a Toyota dealer, should I buy a Toyota? And of course, they've only got one thing to sell you, so they're going to say yes. And so the worst bit of advice I see is people in London going on AIM, which has got terrible compliance, huge costs, no liquidity, no pathway. So AIM doesn't have a main market and a junior market. It only has the AIM market. And half the brokers won't let people trade the stock. So you've got this situation where you can tell your friends we're listed on AIM and they can't buy your shares. It's really not fit for purpose. And, I think that's why Frankfurt now does 1,000 listings a year and AIM does 5. It's just become not fit for purpose.
Okay, so on a completely different angle, if a company comes to you and go, I want to do direct listing, what does one look like that shouldn't be listed? Even if they meet the criteria like a 500,000 EBIT or something, what is
the big ones are the people obsessed with selling. They're not really thinking about the future. They're thinking about their future, how they sell the business. And then, like I say, distressed stuff that can't afford to, they need to raise money to do something because the business can't afford to sustain itself. Those types of things basically are the kind of red flags. They might make good acquisitions for something that's already listed, but not the cornerstone.
The one question around a number of different sectors. So would the creative marketing, PR, comms industries be attractive? I guess it comes back to the point you made earlier, Jeremy, isn't it, about the story that you're able to tell?
Yeah.
So are there any particular sectors that are more attractive than others or can create a better story than others?
Pitch me. Yeah. Show me something and I'll tell you. It is kind of say it out loud. And if it sounds great, it's probably great. And I mean, even some of the, like I say, the more boring style businesses, you could see how fragmented the market is and how the opportunity to sweep all the players, smaller players to make a bigger player. So you can see angles with even stuff that doesn't sound exciting when you say it out loud.
Yeah.
What's that top question?
I think we've covered that one.
Okay.
I think all the questions we've been through now.
Perfect. Okay. So would you like to do closings?
Yeah, I mean, I think now's a chance for me to be bold and see if I can summarise what the sort of takeaways are from the webinar so far. So Jeremy, jump in if you want to add anything. But here's my sort of attempt to go through that now. So I suppose really the first part we sort of started off with was around direct listings and IPOs. So direct listings are obviously a lot less complex and costly and time consuming than an IPO. If I'm a business owner, then direct listings are great if I want to increase the valuation of my business. They're great if I want to increase the credibility of the business and acquire other companies and got a great pipeline and a good equity story. Also good if you want to take some money off the table in the short term, but really it's more about the long-term significant wealth building. That's really the name of the game. Not so great if you want to stay the same size, you don't want to grow by acquisition, if you want a quick sale, if the company's distressed or loss-making, and also if you've got an EBITDA that's sort of sub 500k. The other things to be aware of if you want to go down the direct listing route, high level of governance in that, no dodgy social media posts, at least on the junior markets, clean financials needed. And then you also stress, Jeremy, that it's, this is a 5-year plan at least, but it can create insane wealth. So is anything that I've missed out there or got wrong?
I'm just disappointed I spent 40 minutes explaining that. So you did it in 10 or in 5 minutes. Yeah, brevity's a superpower, so well done.
Fantastic. All right. So we're fairly close to the hour. I mean, a big thank you to Jeremy for coming on to the webinar today and sharing your experience and insight. If you're a business owner and feel like your business might be a good candidate for a direct listing, then you can also get in touch with us for a chat. And we'll put some contact details up at the end.
Thank you.
Wonderful.
Great.